So what you're saying is you can't really predict the market. We've never talked about this before.
Well, it's not. I mean, it's not that you can't try to. You can't try to use the tools that you have to think about the market. So if I know with absolute certainty, if my indicators tell me no recession, inflation's coming down, the Fed's going to ease, no recession, then I have a decent sense of what market leadership's going to look like. Um, I would expect broader markets, cyclical, small cap value to do well. But that doesn't matter to me if it's Donald Trump or Kamala Harris.
So let's talk market outlook a little bit. Where do you see markets? Obviously, this is best guess type stuff over the next 12 to 24 months. And we talked a little bit about this is a pretty unique period, but is there any other period in history that is, at least similar?
Well, I'll give you two. I do expect the markets to be higher over the next year and two. And that comes back to my point that once you have peak inflation and peak interest rates, the markets tend to do well over the subsequent years. And that's certainly been the case so far. Somewhat, you can think of 80, 81 or 94, 95 as perhaps reasonable analogies to the current environment. 80, 81, an inflation environment where the Fed raised rates pretty significantly. You did get a recession, right? So you did have to come down 25%, but market did great. Even though you had to deal with the recession in 81, if you invested when inflation peaked in March 80, you were thrilled over the next 5, 7 years. So that's one. The other one would be a 94, 95, where the Fed raised rates by 3% to bring down inflation and then stopped and slowly lowered rates a bit, not a lot, but slowly. And the market sold off a bit during the tightening, but then went gangbusters in the years after it. So it's really a question of, in my opinion, hard landing or soft landing. It's a question of whether we need to give back 20% before going higher, or we do a garden variety 5 to 10% down again before going ultimately higher. But either way, I come to the view that this is a market that has room to run. And when you look back a couple of years from now, it's more likely than not that markets are higher than they are today.
What about income-seeking investors? Obviously, a little different than your traditional longer-term investor in
The
this
one
market.
challenge that income-seeking investors have, it depends how they're positioned right now, but you see people like money markets. They like, particularly if they're at the regional banks, they like their bank deposits because they're getting nice short-term yields. But that, if you like something for 30 days, you should probably want to like it for 5 or 10 years. And, the problem with short-term paper is that you're going to have to roll it. And so we all kind of have a sense of where the Fed's likely to take rates. So we call that reinvestment risk. Now, in 2019, people were begging me, they were probably begging you for 4%. And in order to get a 4% yield in 2019, I used to have to tell people to buy high yield bonds, which are riskier in nature or have higher default rates historically, or I had to tell them to lend money to the Russian government. So it wasn't that easy back then. Now you can get 4% or higher in corporate bonds, in municipal bonds, in a total return bond portfolio. You can get 8% in high yield, right? That's almost equity like. So investors should think about what they're targeting with regards to income and how they could build a diversified mix to get the income that they want, rather than being, sitting here with the reinvestment risk that they. I'll give the example. My dad talks about the early '80s when short rates were 18% and 30-year rates were 16%. Right. And he didn't want to lock in 30-year at 16% because he thought rates were going a lot higher. And as a result, the Levitt family I had to grow up in modest means because he wasn't getting his 16% a year. And what happened? That 18% went all the way down to zero by '08. right? So you reinvest it all the way down to nothing. So that's the risk. I mean, versus what if I could have had that 30% for 16 years? 16% for 30.
16,
Willy
30
Wonka,
years.
strike that, reverse that. You know what I mean? And now 4% is not 16%, but it's the same concept.